The Commercial Real Estate Show is brought to you by CREshow, forward-thinking advice to navigate business and financial issues. Visit CREshow.com. By BB&T, banking, business, and commercial real estate loans. Visit BB&T.com. And Arnold, Gold & Gregory, a law firm that makes a difference. Visit AGG.com. And Bull Realty, when your business requires proven performance, visit BullRealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to explore the U.S. industrial market. Is manufacturing coming back to the U.S.? Are corporate leaders willing to expand in the current economic and political environment? And how are online sales affecting the sector? And what should we expect for sector performance and investment sales activity and cap rates in 2013? Well, today we'll answer all your questions. Well, maybe not all of them, right? We won't answer like the meaning of life or anything, but all your industrial questions we'll get to. All right, let's get to some questions we can answer. Please welcome my first guest, Ryan Severino, senior economist with Reis. For more than 30 years, Reis has been a trusted provider of impartial commercial real estate performance information and analysis. Reis provides updated trends and forecasts of rent, vacancy, and inventory for apartment, office, retail, and industrial properties in up to 200 metropolitan areas and more than 6,300 markets and segments. Ryan, welcome back to the Commercial Real Estate Show.
Thank you, Michael. Great to be back.
Well, thank you, Ryan. And I'd just like to know, how did the U.S. industrial sector overall perform in 2012?
I would say overall that industrial had a pretty good year, all things considered. In the warehouse distribution subsector, we ended the year with a 12.3% vacancy rate. That was down about 80 basis points from where we ended the prior year. Asking and effective rents both grew between about 1% and 2% during 2012, and that's a nice reversal from 2011 when rent growth was still negative, unfortunately. In the flex R&D subsector, we ended the year with about a 13.9% vacancy rate. That was actually down about 120 basis points or so from the prior year. We again saw asking and effective rents grow a little bit, about 1% for the subsector during the year. So not quite as robust as we saw in the warehouse distribution subsector, but I would say that's still a pretty heartening showing. So clearly, we've seen a resurgence in demand, a resurgence in net absorption in both subsectors during the year. So overall, I would say it was pretty good.
Well, that's great. I guess landlords and investors are glad to see that growth and a little bit of rent rate growth as well. That's great. Well, what do you expect to see for the industrial sector moving forward in 2013?
I'd say we expect it to be kind of another year of this somewhat tepid recovery for both subsectors. We expect vacancy rates to continue to trend downward this year, probably by another 50 basis points or so in each subsector. I think we'll start to see rent growth accelerate a little bit in both subsectors for asking and effective rents, probably in the 2% range, give or take, for both of them. I would say we expect to see net absorption to be, about on par with what we saw last year. So I'd say, generally good things ahead for the industrial sector. We're still not seeing huge acceleration in construction, so as long as demand remains fairly stable, we should see improvement out of the important data points for the market.
And much better than 2012, you're saying then?
Yeah, I would think we would definitely start to see some improvement relative to 2012.
Okay, and what are the top factors that you see affecting the industrial market, Ryan?
Obviously the continued improvement of the economy is of a paramount importance for the sector. And I would say given the fourth quarter's preliminary contractionary reading in the economy, that's a little bit in doubt right now. But there are certainly a couple of other factors that I think will really impact the sector as well. Although, overall retail sales growth is not as robust as we would really like to see at this juncture, e-commerce sales continue to perform well. The nice thing for industrial is that it benefits from demand for goods irrespective of which channel the goods are distributed through. So as long as we continue to see growth in e-commerce, that is certainly a boom for this sector. The other factor I think that could help this year is the recovery in the housing market. Now, this is still in its nascent stages, but housing recoveries create demand for things like furniture, home goods, and home improvement goods. So if the housing market recovery can continue this year, that'll certainly be a positive for the sector.
Yeah, that's a good point, especially in those markets that are real dependent on the housing industry. And let's turn our focus to investment sales. Has industrial been a really sought-after asset class in 2012?
I would say that depending upon who you talk to, what segment of the market, there has been a fairly strong interest in the sector. Overall, we saw sales volume continue to mount this kind of slow recovery. Our data's still a little bit preliminary, but last year transaction activity was slightly up versus 2011 levels. We certainly continue to rebound from the doldrums that we saw during the recession. We're still waiting for some data to come in from the non-disclosure states, but I would say that we expect arm's length transaction volume to be greater than $20 billion this year, which would be the highest that we've seen since the economy began recovering.
Yeah, well, it seems like a safe asset class, doesn't it, compared to maybe retail and some of the sectors that do more spec building, right?
Yeah, absolutely.
What about cap rates? What did you see for cap rates on various industrial property types in 2012?
Again, our data is still a little bit preliminary, but what I would say is cap rates continued to compress during 2012 for both subtypes. Warehouse distribution continues to garner, I would say, somewhat stronger interest, as the economy and retail sales rebounded a little bit during the year. Flex R&D continues to lag a little bit just because it's a little more heavily dependent upon small businesses, which we haven't really seen recover as quickly as large businesses during this cycle. But generally, we're seeing caps in the mid-single-digit range, 5 to say 8%, depending upon the market, and that's a much healthier place than we were even just a couple of years ago.
Yeah, that's great. What do you expect moving forward in 2013 for cap rates?
I'd say we expect to see continued declines in cap rates, although the magnitude could slow a little bit after a few years of cap rate compression. What I would say is, however, as long as the Fed is going to keep interest rates low, with improving fundamentals and compressing risk premiums, looks like it could be more of the same ahead for industrial. Maybe another sort of in the neighborhood of maybe a 50 basis point compression, certainly depending upon the economy this year.
Right. Well, it does seem like a good time to get into industrial properties at this time in the market and this time in the sector. What do you see for performance variances between markets? Are there certain property types and areas of the country seeing more demand?
I would say on a geographical basis, demand continues to be the strongest at the ports and the real large intermodal distribution markets, and that's really just due to the pattern of global trade, as most, though not all goods for sale continue to flow into the U.S. from abroad. And for the time being, on a subsector basis, we expect to see greater demand for the warehouse distribution properties than the flex R&D properties, at least in the near term.
Okay, and where do you see opportunities out there for investors or users in this environment?
Clearly there's an appetite for, large, modern Class A buildings. I would say, especially as warehouse distribution becomes more computerized and robots become a more important part of supply chain management, those types of buildings are really commanding a bit of a premium in the marketplace. I would say the buildings that can best adapt to this new, more technology-oriented environment will outperform their laggard peers. For those who are a little bit more risk-seeking, a little bit more adventurous, if small businesses finally start to recover this year, as some people are predicting, there could be some attractive opportunities in the flex R&D space because it's been a little bit neglected during this recovery for obvious reasons. But I would say those type of investments are not for the faint of heart. So for those who are feeling a little bit more adventurous, it might be time to start thinking about flex R&D in a way that we really haven't given much consideration over the last few years.
Okay. And Ryan, as we talked about in the intro, you guys track industrial, retail, office, and apartments. How does the industrial sector compare to the other asset types, in your opinion, moving forward in 2013?
It's a little more Goldilocks-like than I would say some of the other sectors. Apartment is scorchingly on fire at the moment. If anything, I think apartments on the precipice of a construction boom that will certainly have ramifications for the sector going forward. And retail, I could spend forever talking about all of the problems that we're still seeing in retail. Office is and industrial kind of in the middle. They're both really driven to a large extent by what happens in the corporate sector, to what happens in terms of consumer performance. And so I would say that the prospects going forward for both of them are relatively bright. I think apartments' better days are probably behind it at this point as construction picks up. I think there's still a lot of issues we need to work out with retail, but I think office and industrial are starting to get into that, not quite that sweet spot, but getting there where investment opportunities over the medium term will probably be relatively attractive.
Well, in 10 seconds, what's the wolf at the door for industrial properties?
If global trade starts to be imperiled because of what we're seeing in Europe, and if we do start to see a bit of a contraction in the U.S. economy, I think that is the kind of situation where you could see trade volume slow down, you could see consumer interest in products start to decline, and then you could see demand, the wind come out of the sails of demand. But I think as long as we're even in a slow, stable growth environment, I think it should be good, if not spectacular times ahead for the industrial market.
Well, Ryan, thanks for joining us today.
You're welcome. Thanks for having me back, Michael.
For more information from the good people at Reis, visit Reis.com. More on the industrial market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.